I think we're going to get a rally between now and the end of the year in the stock market, the so-called Santa Claus rally, but it is a sucker's rally that will not last and should be sold. In contrast, what's going on in the gold market and in the gold stocks, this is not a sucker's rally. This is a new bull market that nobody is talking about, and it's going to coincide with a new bear market in the US dollar.
In today's video, Peter gives a warning that the 2008 crisis was just the prelude to a larger sovereign debt crisis in the United States that may lead to a collapse of the US dollar. Before listening to him, please ensure to smash the like button and subscribe to the channel.
Yesterday morning, the Labor Department released the highly anticipated November non-farm payroll report, otherwise known as the jobs report. And I think a lot of investors were anticipating that we would finally get a miss in the number of jobs created. The consensus was for 200,000 jobs created in November, and I think a lot of people on the street were looking for a lower number, and for good reason. Lots of companies had been announcing layoffs, particularly technology companies. In fact, yesterday, the Challenger job cut report came out, and it showed 76,835 job losses in November. That is a huge number. It's more than double the number of job cuts announced the prior month, and more than 5 times as many job cuts as were announced in November of 2021. And if you get the continuing unemployment claims that were released on Thursday as well, they hit a new 10-month high. So I think there was a lot of reason that investors were looking for a weak number. In fact, I think that's part of the reason that we had the strength in the stock market earlier in the week and the weakness in the US dollar and the continued strength in gold. It was partially on the anticipation of a weak jobs number, which would have taken some of the pressure off the Fed to hike rates more or keep rates higher for longer, because a lot of people incorrectly still believe that inflation is caused by too many people working, and that if we only have more unemployment, we'll have less inflation. Now, that isn't true, but that's what investors believe. But contrary to those expectations, we actually got yet another stronger than expected non-farm payrolls report, at least the way investors were reacting to it. In fact, this is the 7th month in a row where the jobs numbers have come out stronger than expected. And as a matter of fact, this report even included an upward revision to the prior month, which was originally reported as plus 261,000, which was a beat. Well, now it's a bigger beat because that was revised to 284,000. But the November number came in at plus 263,000 jobs. But probably what the markets also reacted to, in addition to that bigger than expected number, was the larger than expected increase in average hourly earnings, which were expected to rise 0.3, which would have been a smaller rise than the 0.4, which was originally reported for the increase in the prior month. Well, that number was revised to up 0.5, and the November number came out at 0.6, double what had been estimated, and actually 50% above the upper end of the range of estimates, which went from a low of 0.3 to a high of 0.4. And year over year, average hourly earnings, which were expected to rise by 4.6, and which would have been a slight reduction from the up 4.7 from the prior month. Instead, we revised the prior month to up 4.9, and November, instead of going down, it rose to up 5.1%. So a big increase in average hourly earnings, both on the month and year over year. And that sent the chill through the market that the Fed would now have to be tighter with its monetary policy because inflation was getting worse due to increased pressure from rising wages. Now, average hours worked actually declined a bit from 34.5 to 34.4, but still, workers got paid more for every hour that they did work. And that, of course, adds to the upward pressure on costs that their employers are already having to deal with. But in reality, it's not rising wages that are going to cause higher inflation. It is higher inflation that is causing wages to rise. Wages are just a price, the price of labor, just like every other price, and prices are going up because of inflation. Rising prices don't cause inflation, they result from inflation. And what this jobs report indicates is higher inflation. Inflation is pushing up wages. Now, they're not going up as much as prices because prices are still up about 8% year over year, and that's the official increase. The actual increase is probably twice that amount. And so real earnings are collapsing. And that is the real story behind this payrolls number. Because contrary to the way it's being described by the media, it is not a strong report. In fact, I read one news story that described the U.S. labor market as being hot. Because of this report, we had a red-hot labor market, according to the media. Well, the labor market is not hot, it's actually cool. In fact, it's pretty much ice cold, and that's what the non-farm payroll report actually reveals if you're smart enough to look beneath the surface. And by the way, you don't have to look very deep. Just looking at the nature of the jobs that were created, they were almost all service sector jobs. Only 14,000 manufacturing jobs were added. That's well below the 20,000 that were expected, and even more below the 36,000 that were added in the prior month. Remember, the problem with these service sector jobs, and a lot of them were in government, they were in healthcare, they were in leisure and hospitality, but these jobs don't produce goods. But the people who have these jobs buy goods. Well, if they're buying goods that they didn't help produce, where are these goods coming from? They're going to come from abroad. These jobs that are being added are simply going to add to the trade deficit as people who have non-productive service sector jobs take their paychecks and buy goods that they didn't help produce. ISM manufacturing index for November sinking below 50. It came out at 49. The prior month, it was at 50.2. The expectation was for 49.9. But again, anything below 50 indicates contraction. And this is the first time that that index has been below 50 since May of 2020. What was going on in May of 2020? That was the depth of the COVID lockdowns. And so the manufacturing sector is as weak right now as it was in the worst part of the COVID pandemic. What does that tell you about the health of the economy and where the economy is likely headed in 2023? But I want to move on and talk about the market's reaction to what was heralded as a much stronger than expected jobs report. In particular, the reaction in the foreign exchange and the precious metals market. Because in the immediate aftermath of the release of that stronger than expected number, exactly what you would expect to happen happened based on what has been happening in the recent past, in that the dollar immediately rallied and gold immediately sold off. In fact, gold was down $20 and the dollar, which had come in weaker on the day, rallied across the board. Again, this is the way the traders have been trained and the algorithms have been programmed to react to what is seen as stronger economic data based on the impact that it has on Fed policy, and how there was no evidence whatsoever that there was any headway being made in the fight against inflation. And so the Fed was going to have to raise rates higher and keep them higher longer. I thought these were fighting words from the Fed, and the markets just didn't buy what Powell was selling because we had a fall in the dollar and a rise in the price of gold in the face of that speech. And I said, to me, that was convincing evidence that the markets had changed, and it didn't really matter now what Powell said, because investors know that he's all bark and no bite. And in fact, we had some real follow-through on Thursday. Gold prices shot up again, better than $20. In fact, we closed Thursday above $1,800 in the price of gold, and silver was even stronger, and the US dollar continued to fall. In fact, on Thursday, we closed below 105 on the US dollar index, and I have been talking about 105 as a key level for the US dollar from a technical perspective. Now, after we got the jobs number, we saw gold giving back a good chunk of those gains and the dollar recovering some of those losses, but then the markets reversed and the dollar sold off and the dollar index closed negative on the day, and gold recovered almost all of its losses. It still managed to close down a couple of bucks just below 1,800, but silver actually finished the day positive. Now, the reversal also happened in the stock market. Dow Jones futures sold off to about negative 500 as soon as the jobs numbers came out. But by the end of trading, the Dow closed positive and the NASDAQ paired its losses, turning what started out to be a large decline into a very small loss. And again, this is further confirming my suspicions that due to this new perception that the markets have of the weakness in the economy and the likelihood that the Fed won't be able to deliver as much in the way of tightening as Powell is now projecting, I think we're going to get a rally between now and the end of the year in the stock market, the so-called Santa Claus rally, but it is a sucker's rally that will not last and should be sold. In contrast, what's going on in the gold market and in the gold stocks, this is not a sucker's rally. This is a new bull market that nobody is talking about, and it's going to coincide with a new bear market in the US dollar, because with the fall on Friday, the dollar index not only closed the day below 105, it closed the week below 105. It closed Friday at 104.5, down another 20 basis points on the day, despite what was seen as stronger than expected jobs numbers. I think the next key level for the dollar index is 102. And if we close below that in the next week, I think there's a good chance that the dollar index could sink below 96 before the end of the year, which would mean the dollar would actually finish 2022 negative, even after being up close to 20% at its highs. By the way, as of right now, the dollar index has lost 9% from its high. And if you look at the Swiss franc in particular, the Swiss franc is now only down about 2% on the year versus the dollar. And I'm very confident that by the end of the year, even if the dollar index finishes up, the dollar will end the year down against the Swiss franc. So it's the Swiss franc, not the US dollar, that will prove to be the safe haven currency. But the ultimate safe haven from all currencies is gold. In fact, looking at the weekly gains, the price of gold rose about 2.5% on the week. Silver up about 8%. The GDX was up 5.2%, and the GDXJ was up 5.6%. But taking a broader look at what's going on here with the precious metals and the mining stocks, gold is now 11% above its lows, and it's now only down 2.2% on the year. Silver has had an even bigger comeback. It's now 32% above its low for the year. Silver is in a huge bull market, and nobody is talking about it. In fact, silver is now down just 1% on the year. And in fact, I am now confident that both gold and silver are going to finish 2022 with gains. In fact, many of the people in the crypto space were pointing to gold's failure to rally in 2022. In fact, gold's losses in the face of surging inflation as proof that gold was no longer relevant and that it had been replaced by Bitcoin. Bitcoin is down 63% so far in 2022, and the Grayscale Bitcoin Trust is down 74%. So if gold's 2% fall means gold's irrelevant, what does Bitcoin's 63% fall mean? Clearly, gold is every bit as relevant as it's always been. It's just that not a lot of people appreciate that relevance, but they will. And in fact, gold could have such a strong finish to 2022 that it may end up beating the official rate of inflation. Whether it ends up beating the actual rate of inflation, I don't know that it can make that big a move in the remaining days of 2022, but I'm sure it will make up that lost ground in 2023, because I am expecting an explosive year for both gold and silver in 2023. In fact, look at what's already happening with the mining stocks. The GDX is now 39% above its 2022 low. That is a huge move, and it's now only down 6.6% on the year. Gold stocks are now stronger than any of the other major indexes. The GDX is no longer even in a bear market, only being down 6.6% on the year. In fact, it's clearly in a bull market, being up 39% from its lows. And in fact, the juniors have made an even bigger move. The GDXJ is now 44% above its 2022 low. Now, it's still down 11.2% on the year, but that would only put it in correction territory on the decline. But clearly, what's more significant is the 44% move from the low, which clearly puts the index in a bull market. But what's more significant about this bull market is that nobody is talking about it.